Hello and welcome to the Money Marketing Podcast. I'm Lois Vallely, Chief Reporter, and this is the final episode in a three-part series brought to you in association with Pru, discussing key trends in the market and how they're affecting different aspects of financial services and planning. This episode, I'm joined by Colin Simmons, Business Development Manager at Pru, to talk about retirement planning. Hi Colin, thank you so much for joining me.
You're welcome, and nice to be invited onto the podcast.
Great. So could I please ask you first of all to maybe tell our listeners a little bit about you and your role at Pru?
Yeah, I've been at Prudential now for over 20 years, and for the last, I think, 17 of them, I've been a retirement income specialist. So I've been helping Prudential sort of pioneer the growth of the retirement market. Started off with annuities, then investment-backed annuities, and more recently, our drawdown and pension proposition. But some advisors might know me as well because I'm heavily involved in the Personal Finance Society as well. So I'm currently chairman of the Thames Valley PFS.
Lovely. That's perfect. So you are well placed then to talk about retirement planning with us. So I think to start off, should we talk about some of the changes that you've witnessed in retirement planning in the time that you've been in the industry?
Well, 20 years is a long time, so I'll try and condense it as much as I can. But I think we've seen two fundamental changes. If I go back to when I first started in pensions as an advisor, pensions was quite a complex area. We had things like carry forward and carry back, and that was all to do with how you put money into pensions. And of course, you had different types of contracts like retirement annuity contracts back then. But along came pension simplification, A-Day as it was known, and things were simpler, but I'm not so sure now. You've got things like lifetime allowance issues, annual allowance, money purchase annual allowance, the dreaded tapered annual allowance, and all those things have sort of been tinkered with since we've had pension simplification. So I'm not as sure as things are as simple as they are. But the most important thing, I think, is it's a huge advice opportunity for financial advisors because clients generally can't get their head around that minefield. So it is a huge advice opportunity.
Okay, so if simplification hasn't simplified, like you said, would you say pension freedom and choice has delivered on what it was meant to?
Absolutely. It's pensions freedom and choice has been the biggest change to the industry that I think has been a positive. Despite me working in an annuity department at the time, so I remember when the change came in, I took a call from my boss who said, "I hope you're not driving because I've got some news that you need to be aware of." And it was obviously the results of George Osborne's speech that day, where he said, no need to buy an annuity again. However, working at Prudential, we went from being the largest annuity provider to being one of the biggest drawdown providers very quickly. Now, I think with pensions freedom and choice, whilst it does give greater flexibility, it creates greater risk, the risk of running out of money, things like that. And again, I think it's a giant advice opportunity as well, so that advisors can advise clients and help them achieve the retirement goals that they want. And freedom and choice enables that.
Great. So, yeah, you mentioned running out of money there. What are some of the other risks that you think there are to be aware of?
Well, running out of money is the biggest, but of course you've got things like accidentally triggering a tax charge and things like that. And modern contracts allow the ability to do things like phased retirement, UF plus, regular UF plus, regular phased, regular tax-free cash release. And it would be sad for an individual to save up to their retirement and then sort of pay unnecessary tax by the way that they access their pension benefits and things like that. But I think for me, the biggest challenge for advisors is around whatever income my client is looking to take, can I determine if that income is going to be sustainable or not? And one area where we help advisors out that is with our PruFund range. It's, the ability to offer a multi-asset investment with layers and layers of diversification, with smoothing on top, does allow you to extract income for longer. And there's evidence that backs that up. Independent research from the University of York, they did a really good paper that sort of drew two conclusions. One, if you increase diversification, which is what we do through size and scale, but two, if you smooth out returns and you give a more consistent unit price, which is what we try and achieve through our smoothing formula, then you can potentially extract income for longer. And that allows advisors to perhaps limit the effects of sequence of return risk and running out of money, that sort of thing.
Yeah, no, I see. And smoothing is something we talked about in more detail in the previous podcast as well with one of your colleagues. So do check that out. So we've talked about how retirement planning has changed then. Where do you see retirement planning going over the next 20 or 30 years?
Yeah, next 20 or 30 years, we're obviously going to see very soon the end of defined benefit pension schemes, and which means everyone will be in a defined contribution scheme, whether they will look this and have the same feel as they do now. But I think post cost of living crisis, to get people to a sort of a similar sort of retirement that previous generations have had, we're going to have to see two things: engagement increase and contribution levels increase as well. So that is a fundamental change that I think we'll have to see.
Yeah, definitely. So how do you think the industry could sort of help get people to save more into their pensions for retirement?
Yeah, there's a few things that are happening, like pension statement season and things like that. And we've got the pensions dashboard coming along, and more creative technologies like things like pension video statements that will encourage more engagement. But I think one area where we could look is the banking sector and how the banking sector has utilized technology. We all bank now differently to how we did 10 years ago. So I think that's certainly an area we should look at. Open banking will ultimately become open finance, and it would be great to have more flexibility with the way that people save and engage with pensions. So I'm a sort of fan of having flexible contributions, or perhaps sidecar savings along with a pension, because I think if they're more flexible, they're more attractive, and hopefully we can get more people saving into them.
Yeah, definitely. You mentioned sidecar savings there. Do you think there's a need for other product developments as well?
Yes, there will be more product developments. You might see, if we have a higher interest rate environment, perhaps more guarantee type solutions coming out. But one area that I want to sort of focus on is, it'd be interesting to see how collective defined contribution schemes or CDC schemes take off, or if they take off. I think the ability to pool investments together from your membership to give you size and scale and access to better investments in your pension. Pooling investments will help you eliminate some of the risks that you face as well. So it'll be interesting to see what happens there. Now, none of that is new, though. That those things like pooling risks, pooling investments, they were the sort of principles of what was with profits before. Now, with profits is sort of not really popular by advisors or consumers, but what we've seen at Pru is the evolution of with profits into PruFund, and that's incredibly popular. So we're able to give people that sort of pooled investment, multi-asset investment expertise, shared risks and things on an individual basis. And PruFund Planet is just the latest evolution of that. And I think the ability of PruFund Planet now on a platform means that we can open up that concept to more individuals, more advisors, and it gives us a sort of edge over some of the other providers out there to offer a smoothed ESG type investment. And what would be great is if over the next 20, 30 years, and I've heard other people talk about this before, that actually ESG and investments are not a separate thing. ESG is actually just normal investments. That as a society, and the pensions industry has a big place to play in this, is actually we invest purely in companies that are going to do societal good and make change and for the benefit of the future, certainly.
Yeah, definitely. No, before I joined money marketing, I really hadn't appreciated the extent to which pensions sort of contribute to sustainability and the betterment of society.
Yeah, and there's been some good things, like if you look at the work that the Make My Money Matter campaign has done, and some of the things around that is hopefully going to create more engagement as well from that respect.
Yeah, definitely. Great. So could you maybe talk us through some of the different ways a client in decumulation can take an income?
Yeah, of course, I sort of touched on it earlier that there's many different ways that you can access the money from your pension. But for me, the important thing that individuals should look to do is first and foremost see if they can take advice around this, because the risk of accessing your pension in the wrong way could access a unnecessary tax charge. And also, of course, is knowing how much money you can take in retirement is really important. And that, again, is where the benefit of financial advice should come in. Now, I always start every advisor meeting that I have where I'm talking to advisors about drawdown is to consider this. How do you determine if the client's income you're taking is going to be sustainable? Now, that's a very difficult challenge for an advisor to work out and portray to a client. And in a way, what an advisor has become is they have become the actuary of their clients. So the client is going to the advisor to say, how much income can I take in retirement? So, to help with that, one of the sort of concepts of PruFund, this smoothing returns and diversifying risk, does help manage that risk a bit better and allows people to extract income for longer, but it's not the final solution. What advisors need is a good process around how they sort of provide advice for clients and that sort of thing, and utilizing the different approaches and also the different tax wrappers means that you can provide your client with the right solution to match the right circumstances, and that's often more important than just accessing your benefits.
Yeah, definitely. So what does good advice look like then?
Well, good. For me, if I was an advisor, I would look at what the FCA has said, not in a drawdown paper, but what they've said in their defined benefit paper, FG 2103, because there's a lot of potential crossover of good advice for DB transfers. And the language that they use in that paper quite a lot is around retirement income. So take that in mind and cross that over to the world of defined contribution and accessing your benefits. So it has some really good processes in that paper around know your client information, things around capacity for loss testing, how to do that. It talks about processes for cash flow modeling and what to do there. And one area under know your client information, which I think is incredibly important for drawdown advice, is the way to sort of go about tiering a client's income. So looking at separating out a client's income from essential spending, lifestyle spending, discretionary spending, and then having that as a non-discretionary and discretionary. And I think that helps advisors in a number of ways, because one, it will allow you to capacity for loss test better, because you can assess, if my client has a loss, where does that impact on their sort of tier in terms of do they move from lifestyle to essential spending? What's the impact there? But the other thing that I think is prevalent today, if I can get my words out, is inflation. Inflation is very high, and the higher inflation, the more risk you have of running out of money, because you're likely to increase your withdrawals to keep up with the cost of inflation. Very difficult to do that in drawdown, so often people don't. But one thing I talk to advisors about is, well, if you can't increase your withdrawals to hedge against inflation, maybe you should consider where are you investing your money. And perhaps your essential spending that needs to keep pace with inflation, you should asset allocate to perhaps exposure to asset classes like infrastructure, alternatives, commercial property, assets that are going to perform well in an inflationary environment. And that's what we talk a lot about in terms of our size and scale of the Pru Fund and the Pru Fund Planet range, the ability to offer depth of diversification into those asset classes and things like that. And the final thing, I know your first question was, the different ways you can decumulate, and I haven't really got there, but the bit that I wanted to, yeah, thank you. The bit that I wanted to say was a theory that's very popular with advisors is around bucketing. So you may choose up to 3 years income in cash, and you may choose 5 to 8 years income put aside in a cautious investment, and the remaining assets you put in a growth investment. And over time, what you do is you cash some units in from one, top up the other, and then top up the other. That doesn't necessarily eliminate timing risk, though, because you don't know when is the right time to do that. So one of the things that we work with is we provide an expected growth rate of the assets that you can invest in at Pru Fund. So that's very useful if you're cash flow modeling to determine what income you can take. But actually what you could do is you can reverse engineer it. And you could say, okay, well, if I buy into this concept that smooth returns works for drawing an income, then I can use my expected growth rates to say, okay, well, if I want Y amount of income for X amount of years, so say £20,000 for the next 20 years, I could work out how much I need to allocate into my smooth fund and let the smooth fund provide income over the next 20 years. And then I can split my investments with something like a DFM or a model portfolio and just use that for a growth strategy for in 20 years time or something like that. And that's something that we talk quite a lot about in terms of utilizing and blending investments from that respect.
Great. No, I'm really learning a lot. Thank you.
Yeah, you're welcome.
So I did just want to talk, you did mention cash flow modelling there. I just wanted to talk a bit more about cash flow modelling. What do you see as some of the sort of advantages and disadvantages?
Yeah, I absolutely love cash flow modelling. I'm a huge fan of it. More advisors should be doing it. And I think under consumer duties, more advisors will need to do it because it's about, assessing outcomes of the advice that you gave. And if you're going to put someone in drawdown, cash flow modeling helps you sort of project forward different outcomes. So there's a real advantage around cash flow modeling from that respect. However, one of the disadvantages of cash flow modeling is bad cash flow modeling is like letting a child mark its own homework. And what I mean by that is too many advisors are just presenting favorable outcomes. If you retire today, you can really live the dream. And that's not really utilizing cash flow modeling to its strength. For me, cash flow modeling is the best way you can assess capacity for loss. And how you would do that is apply some stress tests for your cash flow model. Now, the FCA in their paper on DB advice, they said it's great if you do cash flow modeling, but there's no requirement to do it. And I would stress there's no requirement to do it for drawdown advice as well. But if you do it, what we'd like to see is some stress testing. And actually, the Personal Finance Society has a guide on drawdown advice. It's very good, and it sort of gives 7 ways to stress test. But the FCA in their paper mentioned 2. So if I was looking to stress cash flow model an advisor or build a process around that, I'd look at those 2 as my stress tests. And they are people accessing their pensions early. So, an ad hoc withdrawal, and we might see that with the cost of living crisis. What would be the impact of having to access my pension early? And the other one would be if my client retires and then suffers a market loss soon after taking withdrawals. So that's to sort of demonstrate the effect of sequence of return risk or something like that. Now, how you're going to be challenged on the advice that you give or the file that you put together is the assumptions that you've used, are those assumptions reasoned and reasonable? In other words, why are you saying it's growing at X, and why are you stress testing that you've had a loss of Y? So you can't make these numbers up. And again, another paper from the FCA sort of suggested that the assumptions you use must reflect the assets you're invested in. And why we have been very popular with advisors with our PruFund range is we provide advisors with a long-term expectation of the returns that you're invested in. So if you were to buy, say, PruFund Planet for your client today, we would say, okay, long term, we expect these returns to deliver, say, 5.9 or 6.2 or something like that. And that gives the advisor some parameters to work with to effectively put a report together and a plan together saying, if Pru thinks it's going to do this, what does your retirement look like? If you're getting 6.1 and you're taking 8, what is going to be the impact of that? If you're getting 6.1 or 5.9 and you're taking 4, what is the impact of that? So that's incredibly popular from that respect.
Great. Very interesting. Thank you. So just finally, I did want to almost move back in a way, I suppose, to accumulation more generally. We're in this cost of living crisis. We've got sort of economic uncertainty going on. So what would be your top tips for accumulation?
Yeah, cost of living crisis is a tricky one. I think the industry is now starting to come round and accept that perhaps people are going to stop contributing to their pensions for the time being. Maybe contribution or increases to contributions won't happen. Maybe I'd like to see some flexibility here, where employers are maybe a bit more generous. That if employees have to stop their contributions, the employer still continues to contribute. Now, there's a number of tools and calculators out there to help clients understand the impact of stopping a pension, because sadly that's one of the things that maybe you want to stop last. However, I understand why people are going to do it, because if you've got a mortgage to pay and bills to pay, it's more important to have a house over your head than it is maybe a pension. The pension is way off in the future, so it's very difficult to comprehend that. Sadly, though, we need more education around the benefits of pensions and the benefits of saving long term. And what would worry me is if people were sort of cancelling a pension, but maybe continuing to fund a television subscription service or something like that, and perhaps giving up those subscription services for a couple of years and retaining pension contributions would be a better thing. Sadly, the tools and calculators that would help a client understand this, the majority of them are actually only available through financial advisors and things like that. So that's a bit of a shame, but it does show the opportunity that there is for advisors to engage with clients and talk to them around what is the right thing to do, particularly with workplace savings and things like that. Now, the other thing that I think is perhaps a potential issue, though, is where we have clients that are old enough to access their pensions early, but maybe to offset the cost of living crisis. And again, the importance of financial advice here to do this, because what's going to be the effect on your retirement living standards if you release tax-free cash, say 8 years before you plan to retire, that sort of thing. And again, my warning to advisors on this is don't do cash release from a drawdown without undertaking full advice. And what I mean by that is, we see it when I'm talking to compliance departments of many advisor firms or many networks, that one area perhaps where drawdown advice falls short is where the advisor is not giving full advice around the circumstances of accessing a pension early and not calculating the impact that that's going to have on a client's income or living standard in retirement. So go back to what I said, is look at the FCA's paper on DB transfers. It talks in there a lot that advisors are not order takers, and they need to act in the best interest of their clients. So if you've got a client that wants to release cash early from their pension, in my view, that's full advice. That's full calculation of the impact of what that's going to have on their pension in the future. After all, that's why clients pay for advice, isn't it? They want to know what's going to be the impact, what's the right thing for them to do. So it does create advice opportunities. And one thing where people will benefit from advice is if they do have to stop saving into a pension, if they retain that ongoing relationship with an advisor, they are likely to be back into a pension saving again sooner than those clients that perhaps don't have advice, sadly. So.
Yeah, definitely. Great. Okay. Well, thank you so much, Colin. It's been really great to have you on the podcast.
No, you're welcome.
Yeah, thanks for talking to us.
Thank you.
Thank you so much for listening to the final podcast episode in our series with Proof. Do check out the other podcasts in this series, as well as our video interview with Rich Denning, CEO of M&G Wealth, exploring key market trends and how they're affecting platforms. Also, do make sure you keep up to date with all our content on the Money Marketing website, as well as Twitter, LinkedIn, Facebook and Instagram.